The financial world for years has sung the praises of index funds. They're presented as the easy button of investing, simple, accessible, and promising steady returns. Who wouldn't be tempted? We're told to buy and hold and watch our money grow. But what if this seemingly foolproof strategy isn't as straightforward as it appears? This isn't about bashing index funds entirely. They do have their merits. Because like any investment tool, index funds come with their own set of limitations and potential downsides. By understanding the full picture, you can make informed decisions that align with your financial goals and risk tolerance. So, let's dive deeper into the hidden truths of index funds and uncover what lies beneath the surface.
One of the most touted advantages of index funds is their diversification. By investing in a basket of stocks, they're supposed to mitigate risk by spreading investments across various sectors. But what happens when that basket is dominated by a handful of mega corporations? Think about it. This concentration, while seemingly offering stability, can expose investors to significant risk if those specific sectors or companies face a downturn. History has shown us that market crashes often hit the largest companies the hardest. When these giants stumble, the ripple effects can be devastating, impacting the entire index fund. So, while diversification is a key selling point, the reality is more complex.
This isn't about advocating for one investment strategy over another. It's about empowering you, the investor, with knowledge. We'll peel back the layers, examining the concept of the passive investing paradox. As more individuals flock towards the perceived safety of index funds, we need to question the impact of this mass movement. Does the sheer volume of passive investing create distortions in the market? Can it affect price discovery and market efficiency? These are critical considerations often left unaddressed. By understanding these dynamics, you can make more informed decisions and navigate the complexities of the financial world with greater confidence.
The S&P 500, often hailed as the benchmark of the US stock market, might not be the diversification haven many believe it to be. While it encompasses a broad range of companies, a closer look reveals a heavy concentration in a few key sectors. Technology, in particular, looms large, casting a long shadow over the index's performance. This means that when you invest in an S&P 500 index fund, a significant portion of your money is riding on the fortunes of these tech giants. If the tech sector experiences a downturn, as it has in the past, your portfolio could take a substantial hit. History has shown that market crashes can be sudden and severe, often catching investors off guard. To mitigate such risks, financial advisors often recommend a more diversified investment strategy, spreading investments across various sectors and asset classes. Exploring global markets and emerging opportunities can provide additional layers of diversification, potentially safeguarding your portfolio from sector-specific downturns. Ultimately, a well-rounded investment approach can help ensure long-term growth and financial stability, even in the face of market volatility.
While the tech sector's dominance in the S&P 500 is undeniable, it's crucial to recognize that other sectors also play a significant role. Healthcare, with its aging population and constant innovation, commands a considerable portion of the index. Financials too hold sway, reflecting the economy's reliance on banks and financial institutions. This interconnectedness is vital to grasp because a downturn in one sector can have ripple effects throughout the market. For instance, a slump in consumer spending could impact not just the discretionary sector, but also manufacturing, transportation, and even technology. The energy sector, with its ongoing shift towards renewables, also plays a pivotal role in the index. Index funds, by their very nature, don't differentiate, potentially leaving investors exposed to these interconnected risks. Diversification, when achieved through a single index, may not provide the level of protection investors often assume. Real estate, too, is a significant player, with urban development and property values influencing the broader market. Finally, the global market's interconnectedness means that international trade and geopolitical events can also impact the index, adding another layer of complexity for investors.
The widespread adoption of index funds, while driven by sound reasoning, has created an interesting dynamic in the financial world. As more and more investors pile into the same basket of stocks, it raises questions about potential market distortions and the creation of an index fund echo chamber. Imagine a scenario where a particular stock heavily weighted in a popular index experiences a surge in price, not necessarily due to its inherent value, but because of the sheer volume of passive investing flowing into it. This can create a feedback loop where rising prices attract more passive investors, further inflating the stock's value, potentially detaching it from its true fundamentals. The echo chamber effect, where dissenting voices are drowned out by the chorus of passive investing, can create blind spots and amplify risks. This phenomenon can lead to a market where prices are driven more by the mechanics of index fund investing than by the actual performance and potential of the underlying companies. In such an environment, the traditional signals that investors rely on to make informed decisions can become obscured, making it harder to distinguish between genuine growth and inflated valuations. As the echo chamber grows, the risk of a sudden correction increases, potentially leading to significant market volatility and unexpected losses for investors. It's crucial for investors to remain vigilant and consider the broader implications of their investment choices, ensuring they are not merely following the herd, but making decisions based on sound analysis and understanding of market fundamentals.
Index funds, often seen as a stabilizing force in the market, might be playing a more complex role than many realize. The sheer scale of passive investing, with trillions of dollars flowing into index tracking funds, has the potential to warp market dynamics. Think about it. When a company gets added to a major index like the S&P 500, it triggers an automatic buying frenzy from index funds obligated to hold that stock. Conversely, when a company gets dropped from the index, it faces a wave of selling pressure. This dynamic can lead to price movements that aren't necessarily reflective of a company's true underlying value. Understanding these nuances is crucial for investors who want to navigate the complexities of the modern financial landscape. By being aware of the potential pitfalls and staying informed, you can make better investment decisions that align with your long-term goals. The popularity of index funds has undeniably reshaped the investment world, but it's essential to recognize the broader implications. As more money flows into these funds, the market's behavior can become increasingly detached from the fundamentals. This can lead to heightened volatility and unexpected market movements, which can catch even seasoned investors off guard. Therefore, maintaining a long-term perspective and diversifying your investments can help mitigate some of these risks. In the end, staying informed and making thoughtful decisions will always be your best strategy in navigating the ever-evolving financial landscape.